Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Today, we are talking the biggest risks to the market. And my guest today is Marko Papic. He is the partner and chief strategist over at Clocktower Group. He's also the author of Geopolitical Alpha, and he is a keynote speaker at Stansberry's upcoming conference in Las Vegas, October 25th to the 27th. Marko, so nice to meet you. Welcome to the show.
Thank you so much. It's a real pleasure to be on.
Yeah, well, excited to get your thoughts, pick your brain a little bit here about market sentiment. You know, I was watching and reading some of your past reports, and back in May, you said that optimism was the biggest risk to the market today. Post Jackson Hole especially, would you say that still rings true?
You know, it's so interesting. So generally speaking, I've been sort of maniacally bullish this entire year, just for a number of different reasons. And so around this early summer, yes, I did think that too much optimism could derail the markets. Why? Well, because the 10-year would have risen if there had been this sort of burst of optimism about growth, both in the US and external. And of course, that didn't happen. And in fact, what did happen is that the 10-year went further down, which is really good for the markets, at least for the US markets, for tech-heavy, growth-heavy, FANG-heavy US markets. And so the markets have continued to go up. There hasn't been a burst of optimism. There's actually been a burst of pessimism due to Chinese deleveraging, which is reversing, due to Delta wave, which I think is cresting, and due to disappointments on the US front in terms of fiscal stimulus. So what we have baked in the cake right now is just a slew of sort of disappointments that give investors actual comfort, because it means that normalization of Fed policy will be relatively slow, but it also means that the 10-year will continue to be well behaved, pushing up FANGs and tech stocks in the US. I think the biggest risk right now to the market is that story is the story of the last 6 months. And I think the biggest risk to the market right now is that, we see the US stock market sort of continuing to trend higher while, corporate spreads are widening, which is usually a bad sign. And also, I think that a lot of the concerns about growth and that have allowed the 10-year to remain well behaved are dissipating or reversing or will over the next month.
Well, that's a really good point, Marko. So let me ask you, if equity markets have responded to growth, but the bond market hasn't responded to growth, let's talk about the conditions for a taper. Explain what type of taper tantrum is pent up in the bond market then.
It's interesting because you could argue that when the central bank begins to tighten policy, there is a period of indigestion. And we've seen this in previous attempts by the Fed to raise rates. So, or normalize. There is a potential for the 10-year actually to go down as investors contemplate whether the move is correct or not, whether it signals, that the Fed is too early. That could actually bring the 10-year down because it forces investors to wonder whether the Fed has moved too early and therefore will stifle growth. And of course, the 10-year yield will go higher if growth is plentiful. And so I don't think that's the case this time around. I think we had the mini taper tantrum that we are going to have. We had that actually already in June. I think most investors are at this point, comfortable with the Fed announcing a taper at some point over the next 4 to 5 months. We already all know about it. All we've done is talk about it. Every investment bank note, basically is about this. And so I don't think that's really an issue. The issue to me is, when do they announce that the taper will end? So how long will the taper take is really important. When does it end? Because that will signal to investors when potentially the Fed is going to start raising interest rates. And so we have this very interesting window right now where if the Fed misjudges this, I'm not worried about upside to yields. I'm worried about downside to yields, because if investors think that the Fed is overly orthodox or too, ahead of the curve, it could tell investors who are right now concerned about growth that the Fed will pile onto those concerns and actually stifle growth itself.
Interesting. Well, I like another point you had made in a previous interview where you said the market has basically been ignoring the Fed since Wyoming of last year. So is this to the market's advantage? Does the market know something the Fed doesn't know? Who wins, who loses here, Marko?
I think, I think the Fed surprised a lot of investors who were positioned for the reflation trade. I mean, myself included, in June. And this is something that I think a lot of investors, I largely agree with this idea that fiscal dominance exists today. That fiscal policy is very relevant in today's world where 1.9 trillion is spent early in 2021 and so on and so on and so on. This is important, but I do think a lot of investors overstated the importance of fiscal policy. And the reason I say that is because if you print a lot of money and you spend it, and you generate a lot of growth and a lot of inflation, and the Fed is whistling in the dark while you're doing this, then your asset allocation goes one way. You're probably going to be short the dollar. You're going to be short US bonds. You're going to be long reflation assets like commodities, cyclicals, emerging markets. And I would argue that most of at least the macro community I cover, was extremely positioned that way, in March and April of this year. But if the Federal Reserve is actually quite orthodox and responds to all this fiscal profligacy with orthodoxy, well, then we have a different situation. Then we have a situation we had in 2018, where you will remember, the Fed raised rates in response to President Trump's fiscal stimulus. So what happened in that year? Well, we had the dollar rally. We had Chinese and emerging market equities do actually quite poorly. And so the Fed really does matter. In June, I think the Federal Reserve kind of shocked a lot of the people in the macro community who were positioned for the reflation trade. The good news is the reflation trade positioning, so long cyclicals, long commodities, long emerging markets, short dollar, short US tech, those positions have been eviscerated over the last couple of months, well, since June. And so I think that we are now setting the stage where the data and politics will speak where markets go next.
Well, I was gonna bring up because looming in the background of all this is the debt ceiling. And will this completely derail whatever plans Powell had, Marko?
It could. Yeah, that's a really, really important question, Daniela. I think that's not enough people are paying attention. It can, because, I'm not sure. And I don't think a lot of investors are sure either whether you can taper with the debt ceiling sort of looming ahead. There's a lot of uncertainties. I mean, the debt ceiling has to be resolved, or else, technically the U.S. will have to default on some of its debt. Obviously, that's not going to happen. But the issue is that we don't really know when the Treasury can stop doing extraordinary action to delay the debt ceiling. I mean, I've heard it's as late as the late November. But that creates a real problem because over the course of several months, the Democrats can easily resolve the debt ceiling, easily, like this. They can just throw it into a reconciliation bill and then pass it with 50 votes in the Senate. So they don't actually need Republicans. The problem is that there's no chance, in my view, that $3.5 trillion reconciliation package, which, by the way, hasn't even been written. Let's just be clear on that. I don't think that they can write it and put it for vote until November. And so I do think the Democrats are playing with fire here. I think they are trying to put Republicans on the spot by not raising the debt ceiling themselves. And I think that the Fed may have to delay its taper. That may be one of the risks out there that happens, but I don't think they will. I think this gets resolved for a number of different reasons. I think that the bigger risk is that the impact on growth from the Delta variable and from various measures that are coming up, and the impact of Chinese deleveraging, which is reversing but is still in the market. I think that there could be more drag on growth that kind of stays the Fed's hand. I don't think that they're going to delay it, but it could.
Very good point, Marko. And I guess the big question here I want to get from you is, which sectors do you like right now, given the context you've just laid out for us?
Okay, so I think for the next month or two, I think it's difficult to see the reflation trade come back. And that would be cyclical sectors, outperforming defensives. That would be value versus growth. So let's talk about that for a second. Yeah. What's weighing on the reflation trade right now? I think what's weighing on the reflation trade are several things. One, this idea that the Fed is orthodox, right? That's first and foremost, that it's ahead of the curve. The second, and I think more important, is data we're getting from China, where the manufacturing PMI basically collapsed today, where there's a lot of growth concerns in China. The third issue is fiscal policy. I think investors have lost faith, patience, hope whatever you want to call it, that there will be more stimulus in the US. It looks messy. We don't understand the process. It's like taking too long. And so, and of course, then Delta as well, as like you could argue the fourth variable. I think that over the next month, it's too optimistic to believe that any of these issues will gain clarity. In other words, we will continue to have a drag on value and on cyclicals. I think the defensives and growth can have another month or two outperformance. The dollar can move sideways, and the 10-year yield can actually come down over the period of next month or two. However, by the end of the year, I do think that the reflation trade will re-engage. Why? First, I think the Democrats will definitely pass the $3.5 trillion reconciliation bill. And I think it will be more profligate, more spending than people think. Why? The Afghanistan disaster actually increases the odds that the Democrats will come together and pass this, because they're running out of time to pass meaningful legislation ahead of the midterm election. The second issue is China. China has stopped the leveraging. They're going to cut interest rates. They're not going to surge infrastructure spending, but they will spend more. And that's because domestically, they're facing political risks as well. So China will actually reverse the policy of deleveraging, which will also contribute to global growth. And finally, I think the Delta wave will dissipate, not because of anything supernatural, but because every wave has always dissipated after several weeks of surging. So we will ebb and flow. So over the next month to two, I think that a lot of uncertainties about growth will be resolved, allowing investors to re-engage with the reflation trade, which is long cyclicals, long value, long commodities, long energy sector, long financials, and so on. I wouldn't put on those trades right now. I would wait for a month or two and to see how my checklist resolves itself, which is, again, China, it's COVID, and then finally it's fiscal.
I need to ask you this, just because I've been covering commodities, especially for the past, close to 13 years now. Why assets like gold wouldn't be soaring right now, Marko, given the economic conditions? As Paulson even said, the stars are perfectly aligned for the metal. So why isn't the safe haven above $2,000?
So Daniela, actually, most people are pessimistic right now. Look, the 10-year, is at 1.2, 1.3, it's struggling. So there is no real growth optimism. In fact, when I speak to macro hedge funds and people in our sort of macro universe, I think the median investor doesn't buy the inflation story. The median investor doesn't buy the growth story. The median investor believes we're still stuck in the last paradigm, in the secular stagnation. That's what the gold price is telling you. That's what the 10-year yield is telling you as well. And this is kind of a shocking realization, because when you see where the ISM manufacturing print is and where the 10-year yield is, it's like alligator jaw chart. And you're just sitting there, you're like, how is it possible that the 10-year is not at 3.5%? Well, the reason it's possible is because I think that it's a really complicated issue. We can talk about a lot of different things, but my kind of gut view here is this.
Yeah.
If you're a professional investor today, if you survived the last decade, what did you invest in? Well, you went long bonds every time the yield went up. You went long bonds. You went long tech and basically short everything else. You were long US assets and short everything else. Definitely did not touch commodities, right? And so you survived the decade of secular stagnation by basically being quite pessimistic in a way, other than on FANGs and growth stocks in the US. That's it. And so it's very difficult, I think, right now for professional investors to get out of their mindset. So a lot of the commentary that you see is kind of like, well, we're not really in a new paradigm. It's still the same. There's still secular stagnation. Growth will go back to trend very quickly. Fiscal policy, who cares? There's a huge fiscal cliff next year. And that's why I think gold is being kept so low, because the expectation of inflation is actually quite low. You can see that by five-year forward. Long-term inflation expectations are actually below their long-term average. There isn't actually a lot of confidence in this inflation-reflation trade.
Yeah. Does that not surprise you, though, Marko, when you say you don't think the median investor is buying the inflation trade? How could that not be?
Well, because, there is a view that we've had a temporary measure, temporary extraordinary fiscal stimulus, temporary extraordinary monetary stimulus, and that both of those will normalize over the course of the next, 12 to 24 months. And I think that that view has been entrenched in the median investor's mind. I think that's wrong. I think the inflation prints we're getting are not transitory. I think they're going to be stickier. I mean, they're not going to be crazy. We're not going to have like 20% inflation, but I think we can easily have 3% inflation for the next 24 months, which is above the Fed's target. And I think the 10 years probably should respond to that. But I think that it's going to take more convincing to convince the median investor, which means inflation is going to have to stay higher for longer. And I think we're going to have to see more fiscal. We're going to have to see China normalize. And as I said, Delta has to be in our rear view mirror, which I think it will be in the next couple of weeks.
And would you say that then and only then would you see a gold rally?
Of course, and that's my point. That's the same. It's the same question you asked about sectors, right? So if you want to be long cyclicals, if you want to be long, value versus growth, I think gold will outperform at that point as well. I think we're going to need a month or two to get some clarity. Now, my checklist, which I think your viewers can kind of get from what I'm saying, I think my checklist for this is: one, China needs to stop being hawkish, austere, and deleveraging. They've already done that. So that is a check on my checklist. Two, fiscal policy in the US has to be resolved, i.e. the Democrats have to get what they want, which I think will be resolved, but that hasn't yet been, we don't have clarity of that. Third is COVID, like COVID has to dissipate. And fourth, I think the Fed needs to taper, but it needs to taper in a way that clarifies to investors that they're not going to start raising rates in middle of 2022. Right now, the market is expecting basically 2 rate hikes by first quarter of 2023. I think if that stays the same or is pushed out, that will also help gold and the reflation trade.
Marko, because it's our first time speaking, I'm just curious to get your thoughts and gauge on cryptocurrencies, particularly Bitcoin. How much of a role do you see Bitcoin playing in gold's stagnant phase right now?
I don't think that can be explained. I think gold has a huge market, and I don't think one is stealing from the other. I think, look, Bitcoin is in some ways a gold alternative, yes, but I think that there's a number of other reasons why you would want to own Bitcoin. So it's not like a one-to-one replacement for gold. And the other reasons for why you want to own Bitcoin, I mean, many reasons. You may think it's a novel piece of technology that will stay as a sort of not just a store of wealth, but also as an alternative currency. You may think that Bitcoin could be an anchor for a new financial architecture. You may also just be a young millennial who thinks it's cool, like, to be quite honest with you, and you don't have enough money to buy a house. You don't want to buy equities because they're not cool because your dad owns them. So you're like, you know what? I'm going to hodl my Bitcoin. And so I think that you should think of Bitcoin as a high beta risk asset, not as a gold alternative. In other words, Bitcoin will do well when liquidity is plentiful, when stocks are going up, when the Fed is being easy, and Bitcoin will not do well when all those three things are reversed.
Yeah.
So I don't think it's a pure gold alternative. I think gold will ultimately rise or fall based on the macro conditions.
No, you're an insider, a Wall Street insider, and I think it's interesting that you're saying Bitcoin is not chipping away at gold's market cap.
No, I mean, I wouldn't call myself a Wall Street insider. I thank you, I think, but no, I mean, it's not like I see something that other people don't. I just have, look, I mean, Bitcoin is one-to-one correlated with the equity risk premium in the US. It's like one-to-one correlated with ERP, which what that tells you is that Bitcoin is a risk asset. Gold is actually a safe haven asset combined with this inflation hedge. So the two are not really the same at all.
Marko, just final thoughts, because a big portion of your work surrounds geopolitical writings and your thoughts on that. And I found it interesting that you said that China and the US relations would love to separate themselves, but they almost cannot. They cannot not coexist. Can you elaborate on that?
Yeah, so I think a lot of investors have been extrapolating linearly the tensions and geopolitical enmity. And I use the word enmity because, like, let's wake up and smell the coffee. Like, US and China are clearly enemies at this point. And that's cool. Like, I mean, countries have been enemies for a long time and they didn't go to war. Like, it doesn't mean we're going to have World War III. I'm just saying, like, they don't like each other. That's clear. But I think a lot of investors and a lot of, I think, armchair geopolitical analysts who have been completely ignoring this issue, by the way, they've been sleeping at the wheel, obsessing about the Middle East, And they wake up one day and they're like, oh my God, China and US don't like each other. So what do? They reach for an intellectual crutch, which is the only metaphor they know, which is the Cold War. It's like, done. We're going to have complete decoupling between China and the US. But it's not that simple. And it's not that simple, not because of supply chains, not because we need Chinese toys, toaster ovens, and T-shirts. No. I mean, that's part of the reason. The main reason it's going to be very difficult for the two countries to decouple each other from each other is because nobody else cares that they're enemies. American allies just don't see China as that big of a risk. I mean, that's the honest truth. I mean, Australia does, India kind of does, Japan, but Europeans don't care. Most emerging markets couldn't care less. Like if you're running Brazil, and I don't care who you are, but if you're running Brazil, why would you side with America? Why? China's far away, it's not going to invade you. You're good. So this creates a real difficult situation for American policymakers because they cannot create a coalition of the willing that abrogates all trade with China. And if you don't do that, you risk losing market access yourself by kind of front running with aggressive policy. What I mean is very simple. If America stops selling Boeings to China, do you really think France would stop selling Airbuses? Of course not. They would up the order the very next day. And that multipolar global distribution of power is what's keeping China and the US from being able to neatly decouple the world into two spheres. Now, there's going to be massive investment opportunities if you agree with me. Like if I'm right and you agree with me, there's going to be a lot of investment opportunities. In particular, I think that the rewiring of supply chains is going to be much more orderly than what people think. And I think that's going to benefit CapEx companies that facilitate the rebuilding of supply chains. So that's why my number one trade recommendation, and it kind of continues to be, really it's not trade, it's an investment, is CapEx companies in the semiconductor space. So don't buy semiconductor companies, buy the companies that build the factories that build the semiconductors as an idea, but you could probably do that in every sector. It doesn't have to be semis.
Good thoughts, Marko. I guess just final words of wisdom for all the investors watching back at home. What would you say in terms of navigating these economic times right now?
Look, I think it's going to be very, very difficult to be sustainably bearish. To put it bluntly, I think that I wouldn't make my investment calls hinge on which way S&P 500 is going. Just don't worry about US stocks. Like they're probably going to continue to do well. I think that you need to find pockets of long-term outperformance. And so I think actually thematic investing is really appropriate. And the three things that I like right now are inflation hedges. I mean, you mentioned gold, but there's also sectors that will do well in inflation. I think that is smart to do because I don't think we're in a transitory world. The second thing I like is anything that has to do with green tech and sustainability. I'm actually going to talk about that at the conference in Vegas. Now, a lot of viewers may kind of not like that theme or be ideologically opposed to it. I just think there's so much policy. I just think that there's so much policy tailwind behind green tech that it just makes a lot of sense, whether you like it or not. And then the third issue is emerging markets. I think emerging markets are going to do well because we're going to spend so much money on rebuilding supply chains. We're going to spend so much money trying to dig up minerals that facilitate our kind of transition to green tech. Emerging markets are going to do well in this environment as well. So those are my three themes in terms of investing.
Okay, very good thoughts. Marko, I appreciate your time today, and I look forward to meeting you in person in Las Vegas at the Stansberry conference. And for those folks out there interested in coming out to hear Marko and to see myself as well, you can register at stansberryconferences.com. Marko, it's a pleasure. Thank you so much.
Thank you so much.
All right, and thanks so much for watching. We'll have much more for you. In the meantime, don't forget to sign up for premier access to content you can't get anywhere else at danielacambone.com. That's it for me. I'm Daniela Cambone.